Everybody, this is Intermediate Accounting 17th edition video solution walkthrough. This is problem 24-1. Textbook authors are the 17th edition, Don Kiso, Jerry Wangen, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, so before we say thank you to Wiley, let's go ahead and take a look at our question for today. So here we have an analysis of various different items over here. And what we're being asked to go through and to do is to go through over here and take a look at these different items for various over here, current liabilities, long-term stockholders' equity, and then it's providing us with additional information. So the best way for us to kind of go through and to do this is let's take the existing balance sheet. So we have over here Almaden, okay, so when we go through over here and look at the existing, right, we're going to, as we type this up, we're going to kind of see a lot of errors, right? So I'm going to have assets, I'm going to have current assets. So we're going to have cash, okay, investments in land, accounts receivable less allowance, inventories, LIFO. So over here, the total current, at least what they're showing right now. Let's make this just a little bit smaller. Or actually, I can do it like this. Okay. So over here, 571. This is 185, 480,000. This is 645,100. So my total current assets are 1,811,100. So my non-current assets are going to be prepaid expenses, or say prepaid expenses, plant and equipment, net cash surrender value of life insurance, an amortized bond discount, notes receivable, short term, goodwill, and then we have land. And so let's go through and take a look at this. Okay, so prepaid expenses are 62,400, 4,130,000, 84,000, 34,500, 162,300, 252, 446,200. So over here, when we add up our other assets, we get 5,171,400, and if I add up that to the current, I'm getting 7,052,500. So that's, as we look at this here, right, that's part of where, again, this is, and as I'm typing this out, I'm already seeing errors, right? And unamortized bond discount, this is going to be a contra-liability account. It is not an asset. Notes receivable short term is going to have to be reclassified in as a current asset because it is short term. Prepaid expenses should also more than likely be short term unless they're non-current in nature. But generally, most prepaid expenses are going to be there. Investments in land, that really should be non-current. But let's go through and just kind of take a look. We'll go through over here. So that's our assets, our liabilities, right? We have current liabilities, So for our current liabilities, we've got accounts payable. Then we're going to have notes payable, which we know is incorrect because in order for notes payable to be a current liability, it has to be due beyond a year. Estimated income tax payable is 145. And then we have premium on common stock. I'm assuming this means additional paid in capital, but we already know that that's going to be in the wrong place. So our total current liabilities is going to be at 962.4, which is what is shown up here. Our long-term liabilities, unearned revenue, dividends payable, 8%, bonds payable. Okay, and this is also that's good and non-current. Both of those should be current liabilities. So our total long-term liabilities, my unearned revenue is 49,500. My dividends payable is 200,000. My 8% bonds payable is 750. So my total long-term liabilities is 1,439,000. My total liabilities are going to be 2,401,900. And then over here we have owner's equity. We're going to have common stock par 1,840,000, and then we're going to have retained earnings of 2,810,600. When I add up these two amounts here, total owner's equity. So my total liabilities plus my owner's equity, that's how we balance here. So this is my total assets. Okay, so we know that there's a ton of errors with this, but I think it's always good. So this is prepared by client. Now, a few things I want to mention here. When you're going through and working as an auditor, and I don't teach auditing, but I do know there are huge limitations on what you can do for financial statements. I can tell you right now that if you as an auditor were given this pile of you know what, you would have to probably go through and at a minimum write it up as a management letter comment, because it's clear that management who owns these financial statements does not know what they're doing. So just kind of keep that in the back of your mind. So let's kind of go through and kind of figure out what needs to happen, right? So corrected. Okay. So let's go through over here and we'll do a corrected. Now, if we're a consultant, right, and we're assisting as long as it's being disclosed, then it's a little bit of a different thing. So, but let's go through one by one. So the first one is that on May 1st, 2020, the corporation issued at 95.4, 750,000 of bonds to finance planned expansion. The long-term bond agreement provided for the annual payment of interest every May 1st. The existing plant was pledged as security for the loan. Use straight line method for discount amortization. So when I look at this here, what I would want to know, it doesn't look like they've recorded any interest expense. But let's just kind of see why. So the amount of money that they went through and received was 750,000 times 95.4%. So this is going to be 750 times 0.954. We always record bonds payable at its face value, which is 750,000. And we have a discount on bonds payable because we received less than the face value. And so we have over here the discount on bonds payable of 34.5. Now, when it comes to the placement of the bond in terms of the discount on bonds payable, the first thing we probably want to go through and do is that this over here is going to be moved. And so this unamortized bond discount is going to need to go down over here with the 8% bonds payable. So this is going to need to go over here, and this will be showing up as a negative amount. Okay, so I'm showing this up as a negative amount. We're not really doing an adjusting entry, but for purposes of going through it and looking at this, that's what I would have to show up, because on my final balance sheet, this needs to be 0, and this is going to show up as a contra equity account, or it's going to be a contra liability account. So, but now the other thing we have to go through and do is we have to go through and figure out the interest that was paid on this bond. If I'm paying interest on a bond, clearly I'm not making any cash payment, but I have to accrue the interest expense. So right over here, the way I would probably want to go through and to do this is I would basically be debiting. I would have over here interest expense. I would be crediting my discount on bonds payable, and I would be crediting interest payable. Okay, so the bonds earn interest at 8%. Okay, so, and they were due on May 1st of 2025. So whenever I see an interest rate, it is always an annual rate. So over here, bond payable 750. My interest rate is going to be at 8%. So the annual interest is $60,000. From May 1st through December 31st, this was 8 months. So the interest payable would be 60,000 times 8/12 or 40,000. Now, when it comes to the interest expense, if I am going through and amortizing my discount or premium straight line, then what I do is I first figure out what my amortization is. So if this was issued on May 1st, 2020, basically 2021, 22, 23, 24, 25. So it was a 5-year bond. So my discount on bonds payable is 34,500. My number of months to amortize the discount or the premium would be over here at approximately 60, or 5-year bond times 12 months per year. Okay, so my monthly amortization is $575. From 5/1 to 12/31, it was 8 months. So over here, my discount on bond payable, it's going to be amortized by 4,600. So my interest expense would be 44,600. So if they, and I need to check something really quickly in the problem, if they went through and did this, and the reason is because what I have to kind of go through and figure out is that I wouldn't necessarily want to go through and add back something to retained earnings unless it was going to be net of tax, but just give me a moment. Okay, they didn't make any adjustments over here. So what we're going to go ahead and do is, this is going to just look, I don't know, well, we'll just make the best of it, right? So our new amount for the bond payable discount, right? Basically with the amortization, right? So this was amortized by 4,600. So the new amount of my bond payable discount is going to be 29,900. If you think about it, right over here, if I take the discount on bonds payable, so my discount on bonds payable when I issued the bond on May 1st was 34.5. I amortize this by basically by over 46, and I get 29,900. So that's my new amount of my bond payable discount. Okay, the other thing we have over here is when it comes to retained earnings, right? We're not doing anything with income taxes. So therefore, what I'm going to go through over here and do is say, all right, the amount that's going to interest expense is basically 44,600. Okay, right over here. So that's going to impact my retained earnings by bringing it down. I'm also going to have over here under my current liabilities, I also am going to have interest payable for the bond. And this is going to be over here at roughly $40,000. So let's kind of break this down. They didn't record bond interest, right? So, and there's also two, they misclassified the unamortized bond discount and they listed it as an asset. So the first thing we did is we took it out of here and we put it down where it belonged, up where we belong, whatever you want to call it, 34,500. So then what we had to go through and do is to record interest on the bond. So we do that by coming over here and saying, okay, how do we record interest? Well, the interest payable is always going to be a function of the face value times the stated interest rate, which we learned was 8% right over here because it's an 8% bond payable. And so the annual interest is 60 from May 1st to December 31st. This is 812. So my interest payable is going to be $40,000. Now, over here for the discount on bonds payable, remember, I have to amortize this down to 0 by the time the bond is paid off. So over here, when I look at the discount on bonds payable, I had to go through and amortize this. So the bond is a 5-year term or 60 months. If I'm amortizing it straight line, it means my monthly amortization is $575. At 8 months, it gets to $4,600. So over here, you would have discount on bonds payable, interest payable. So my new amount of my bond discount is $29,900. Right. I also have interest payable, right? That is going to be at $40,000. Now for retained earnings, what I had to go through and do is I'm showing this as a negative amount and representing the interest expense because that should have been closed out. Now, I would never do this on this type of a question. I don't even know if I'm going to ask this on one of my exams, but this is retained earnings is net of tax. We're going through here and we're adding this as a pre-tax amount, but it doesn't give us any information about the tax rate. And because I looked at the textbook solution and that was shown, so that's how I'm going through and doing it. Okay, so that's number one. Okay, the bookkeeper made the following mistakes. In 2018, ending inventory was overstated by 183. The ending inventories for 2019 and 2020 were correctly computed. So as long as I'm not presenting 2018 information, I'm going to leave this alone, and that's what your book does. In 2020, accrued wages in the amount of $225 were omitted from the balance sheet, and these expenses were not charged on the income statement. So what I'm going to do over here is I'm going to go ahead and say, we're going to create a new account and we're going to call this accrued liabilities. And this is going to be for $225,000. Okay, and I want to call this as different than accounts payable because if I have wages that haven't been paid, that's a different classification. I want to make sure that I'm going through and showing that correctly. So this is going to show as a negative to retain earnings. Why? I would be debiting salaries and wages expense, and I would be crediting accrued liabilities. Okay, so over here, when I'm crediting accrued liabilities for the 225, right? That's going to increase my liabilities, but the expenses are going to be closed out to retained earnings. So this is going to reduce the amount of my retained earnings. Okay, so in 2020, a gain of 175,000 net of tax on the sale of certain plant assets was credited directly to retained earnings. So just give me a moment. So part C, this is going to have, and I agree with the text, is that it has no impact on the balance sheet. Now, if I was presenting the income statement, that would be different, because again, it has to flow through the income statement first, statement of cash flows, before it reaches the balance sheet. So this is going to have so both A and C have no impact. We've dealt with the letter B. Okay. Now, number 3, a major competitor has introduced a line of products that will compete directly with Almaden's primary line, now being produced in a specifically designed new plant. Because of manufacturing innovations, the competitor's line will be comparable quality, but priced 50% below Almaden's line. The competitor announced its new line on January 14th, 2021. Almaden indicates that the company will meet the lower prices that are high enough to cover variable manufacturing and selling expenses, but permit coverage of only a portion of fixed costs. Okay. So this is something over here that when we look at the disclosure, and it doesn't really talk about it, basically, this is the problem, is that, okay, so the first thing is, would we go through and do anything on 2020? The answer is no. But because this was announced, its new law on January 14th, what we have to do is we would have to disclose this as a subsequent event. When we look at subsequent events on the financial statements, let's go to meta. Okay, hold on. Okay, so I went to Twitter. Always fun. Okay, so I'm going to go over here to the quarterly report. Okay, and in the quarterly report, what I'm going to go through and look at is I'm specifically looking for subsequent events. So I'm just going to go ahead and do a search. So over here, if I look at, so note 16 to the financial statements. Okay, so if we think about it, this quarterly report covered us through, or covered Twitter through this 10Q. It's covering us through March 31st. Mr. Musk, this quarterly report was issued on May 2nd or May, like the last few days. Now, whether, if you're being bought, you still have to go through and make your disclosures appropriately. So because of the period of time between March 31st and then May 4th or whatever it might be, what we're looking at here is what are the subsequent events. So on April 15th, which is after the quarter end, the company authorized and declared a dividend distribution right of 1 each for each outstanding shares of the company stock. Each right entitles the shareholder to this over here. And then they adopted the rights agreement to protect themselves, and they made an amendment. And then they basically, the merger agreement, and it's essentially over here where we go through and look at this. And I think this is where they basically said that they would be going through and then agreeing to sell to Mr. Musk, but I might be off over here on these dates. But the important thing for us to know from this is looking at, our particular situation. This happened after the results, right? So what I need to go through and do is I need to basically say that I would say that and you're going to want to talk to legal counsel when you draft this language. Remember, when you're filing a 10K or a 10Q, it's not just management, or actually it's management who's going through and doing it, but you're going to want to talk to your outside counsel about how to go through and phrase this. Because if you phrase it incorrectly or inaccurately, it can basically cause a problem. Why do we have to go through and do it? And it's essentially because you can meet the lower prices, but if you do so, you're going to be doing it at a loss because you're only covering your variable costs, but only a portion of your fixed costs. And depending on the inventory costing method that we're going through and using, we're now going to be selling inventory at a loss, at least on our books. So that would require disclosure as a subsequent event. So that would be how you would do it. And management has to draft this. It's not the auditor's responsibility to draft this statement. These are management's financial statements. Management needs to go through and state what their plan of action is or whatever may have you. So that's where, again, that's something right over here has to be, this basically discussed. Okay, looking at this next one over here is that when we look, okay, so when you're looking at number 4, you learned that after year end, prior to the completion of the audit of heavy damage because of a recent fire due to one of their 2 plants, the loss will not be reimbursed by insurance. The newspaper described the event in detail. Yeah, you better go through and include it, because if you don't, you're going to get sued. So you want to make sure that over here, this is public information, regardless if it's public or not. And if this is going to cause a fire to one of the plants, is going to cause construction delays, and it's not being, you don't change anything on the financial statements themselves, but you are going to go through and you're basically going to make sure that that is disclosed as a subsequent event and the approximate loss that you're going to be suffering as a result of this. So that's where we kind of are with that, with that information, but you would want to go through and fully disclose it. It's very, very important. And it's the users of the financial statements would want to see that in there. Okay. Now let's take a look at the corrected part. So we've dealt with the additional information. Okay. So let's kind of now take a look at our, where we are. So when we look over here at the cash. So again, if it was me, I would be going through and doing this a little bit differently. And what I mean by that is I would tell you that includes, this 571 includes 300,000 for plant expansion. So what we're going to say over here is under non-current assets, we're going to say cash reserved for plant expansion. And this is going to be adding over here 300,000. Okay, so let me just pause a second. Okay, so what I'm just doing here is I'm breaking this out. So I've got cash for building. I'm doing my accrued wages. And then over here, I'm doing the interest, and then I'm reclassifying the bond payable discount. So that should correct that particular. Okay, investments in land. That's not going to be a current asset. So let's go ahead and get rid of that. And we'll just go ahead down here and we'll just call it over here, investments in land. Okay, the other thing we're going to go ahead and do as well is when it comes to showing accounts receivable, what we want to do is that, and I do agree with the textbook on this, is that you want to show, and we can just add in 2 columns above here. You're going to show accounts receivable less the allowance for doubtful accounts. So if the allowance for doubtful accounts was 30,000, and then that basically must mean that the accounts receivable themselves were 510,000. And we'll just call this an AR reclass. Okay, so this is how it should be shown as 510 minus 30 equals 480. That's all it really is. Inventories LIFO is fine. Let's now go over here to our total current assets. Investments in land. Okay, so prepaid expenses, reclass. So what this should be over here, if we're going in order of liquidity, prepaid expenses, this should be 62,400. And this should be reduced by 62,400. For the plant and equipment net, again, similar to the, and just by the way, really quickly, your textbook shows property, plant, and equipment is separate from like investments. I generally just see it broken down into 2 categories. Most companies will just show current assets and they'll dump everything else below. Apple, I think, does it really well. So you'd have here plant and equipment less accumulated depreciation. So over here, so the reclass, so PP&E reclass. So this would be the amount of the accumulated depreciation was 1,430,000. Okay. Okay, so you got property, plant, and equipment reclass, cash surrender value of life insurance, that's fine. Unamortized bond discount, we already got rid of it. Okay, notes receivable short term does not belong in. So this is going to be notes receivable short term. So my notes receivable short term. And let's call this disclosure. So the notes receivable short term, this is going to be 162.3. Okay. Goodwill is fine. Land is land over here. This is fine. Now, when we say over here investments in land, I am assuming that this land is something that is being done over here for purposes of when we go through and look at this, I'm assuming that this land is being used in our plant as opposed to an investment in land. So that's kind of the difference. Let's now go through over here and take a look at our different items for our liabilities. So the notes payable due 2023. Notes payable, this is not a current liability. So what we're going to go ahead and do over here is we're going to put notes payable. And then we're going to add in some other columns here. Okay, so the notes payable reclass. Okay. So your notes payable reclassification is going to be, and this needs to go down to notes payable. And again, I show this in the order of liquidity, or basically when is the most current one due, but I don't have that information. Income taxes payable, that's fine. Notes payable, we got rid of. Interest payable, we did before. Accrued liabilities is fine. Premium on common stock, this needs to be taken out. This is also known as additional paid in capital. This needs to go down to owner's equity. So over here, this needs to be at 150. Okay. Okay. So now as I look at this over here, so I've got accounts payable, notes payable, income taxes payable, premium on common stock. I've dealt with that. My current liabilities. Okay, so I've got notes payable. Okay, right over here, both unearned revenue and dividends payable cannot be long-term. Dividends payable, unearned revenue. So over here, my dividends payable is now going to be 200,000. My unearned revenue is going to be 49,500. The only way that these balances could be showing up as non-current is that if there was some sort of a discussion on it. Okay, so bond payable discount, total long-term liabilities, will change those numbers momentarily. Common stock, par, additional paid in capital, common stock. Okay, so I think we're now ready to roll it. So let's go through over here and see where we are in terms of our final balance sheet. And I want to do this before I go and do anything else. Okay. And over here, so I want to make sure I'm not deleting any critical information. Okay, unearned revenue, and then reclass of the, what would we say, APIC or unearned revenue. Unearned revenue and dividends payable. Reclass. Okay. So now for my corrected balance sheet, I'm going to have assets. So I'm going to have current assets. And over here, I'm going to list out my cash. Now, when I'm listing out my cash here, I'm taking out that 300,000 that was reserved for plant expansion. So this now just shows as 271. The investments in land was reclassed. So that's going to go ahead and go down to 0. My next one over here is I'm going to have my accounts receivable less my allowance for doubtful accounts. It's going to give me accounts receivable net. So this would be shown up here as 510 minus 30. And this over here is going to give me 480. I added in prepaid expenses because that is in fact a current asset. Prepaid expenses inventory at LIFO, notes receivable short term, and this is going to give me total current. So my prepaids were 62.4. My inventories at LIFO have not changed. My note receivable short term is 162.3. So my total current assets are going to be over here at 1,620,800. For my non-current assets, And I'm doing this differently than your textbook just because I've seen different companies do different things. So I'm going to have investments in land. This will be at 185. I'm going to have over here plant and equipment less accumulated depreciation gives me property, plant, and equipment net. Okay. All right. Okay. Next one over here is going to be cash surrender value of life insurance. This is going to be at 84. The bond discount we removed. Notes receivable short term. This is going to be, we got rid of that, so that's not applicable for what we're doing. We're going to have goodwill. The GW is goodwill. And then we have land of 446. We're going to have cash reserved for plant expansion of 300,000. Okay, so my total non-current assets will be my total assets are going to be 1,628,000 plus 5,397,000 or 7,018,000. Okay. There's in your text, it's saying goodwill at cost. I've never seen it like that in real life. So, just take that for what it's worth. Okay. So my liabilities. Okay. Let's just clean this up a little bit. Okay. Liabilities. Current liabilities. So for my current liabilities, what did we have? We have right over here. We have our accounts payable. The accounts payable is at 510. We're going to have dividends payable. We're going to have unearned revenue. The dividends payable was at 200. The unearned revenue is 489.5. We reclassified the notes payable. The estimated income taxes payable are at 145. My interest payable on my bond and my accrued liabilities. And we reclassified the premium on the common stock. So my total current liabilities is going to be over here at 1,609,500. Okay, so for my non-current liabilities, what I'm going to have over here is I will have, and again, I would do this in order of liquidity. I'm going to have notes payable. The notes payable is going to be at 157,400. I'm going to have a bond payable less my bond payable discount. So my bond payable was at 750. After the bond interest was amortized, my bond payable discount will be at not 34,500, but over here, less that amortization of 29.9. This is going to give me bonds payable net of the discount over here at 720,100. So over here, my total non-current liabilities will be 877.5. My total liabilities will be 2,487,000 for my owner's equity. Okay, I'm not doing any of the stuff with like, oh, like this is at par, whatever may have you, but let's just go ahead. We've got common stock at par, additional paid-in capital common stock. So my common stock at par was 1,840,000. My additional paid-in capital was 150. For my retained earnings, my initial amount was 2,810,600. But then I deducted interest expense and I deducted the accrued wages. So my total owner's equity would be 4,531,000. My total liabilities plus owner's equity is going to be 2,487,000 plus 4,531,000, or 7,018,000. Okay, so as I look at this over here, then I would have also listed out as subsequent events in the footnotes, the financial statements, among many other things, is I would talk about item 3 and I would talk about item 4, but that would need to both be in the subsequent event list. So that is problem 24-1, and it's probably more 24-1 than you actually wanted to have. So I want to thank Wiley for allowing me to continue to use their product and to, well, the magical blue stuff out of the back of the Winnebago, maybe, maybe not. But I want to thank you for being here to watch today. And please don't forget to like and subscribe. If you're looking for other solutions, please feel free to ask for them in the comments. If I have the time, and you have the beer, I will, that's a commercial, by the way, from the 1970s. I will more than likely try to get you that video as quickly as I can, but in any event, have a great day. I'll see you soon.